great group. And first, I just want to say thank you to the University of Georgia. Georgia is so important to us. Like when we look at our team, look across the room when we're in meetings, when we're thinking about how do we go to market, University of Georgia is the heartbeat of our bank. And so I am excited to be here today talking to you all about Synovus, talking about the banking industry. But most importantly, just really want to say thank you to the school, Terry College. You all are firing on all cylinders. Right? When we look at the rankings, we just saw rankings come out with Forbes, Princeton Review. I think it's number 13 best value public universities, number 19 overall best public universities. I mean, these rankings, the accolades continue to come in. Georgia is simply winning, and we believe that helps Synovus win. So that's exciting to us. So thank you so much for having me today to speak on behalf of Synovus. We are clearly big fans. I want to talk about a few things today. I want to talk about who we are. I want to talk about a little bit of a look back. Let's look back over the past couple of years and kind of what's happened, but it has been an incredible ride. And then I want to talk a little bit about how we view the future, because it is a very interesting time in the banking industry. And I was trying to think of a fun way to say, how can we celebrate being here today at Terry Third Thursday? And so I decided to make a big announcement for all our clients that have floating rate loans. We're going to reduce your rate 50 basis points. It's a fascinating time. The easing cycle is finally here, and that's exciting for us, actually. We think that's actually a good thing. And I'll talk a little bit more about that. And so, first, who are we? I think everybody here is familiar with Synovus. We are the largest bank headquartered in Georgia. This is our home state, as I mentioned. We're pretty excited about it. We think that is one of our number one reasons why we have a right to win. It's why we have been winning. We think it's why we'll have the right to win going forward. It's because of the strength of the underlying economies of where we are. We are in 5 states. You can see the map right here. But when you think about us, it's largely driven by Georgia and Florida. Those are our largest states. Alabama would be right after that, and then Tennessee and South Carolina. We're $60 billion in assets, have about 250 branches. But that's kind of the fundamentals of who we are. I would really say that who we are and what we get excited about is on the right side of this slide. It's winning Greenwich Awards, where it's our clients coming to us and saying, you know what, you guys are doing a great job. We're really pleased with the relationship with Synovus. I sleep at night knowing that my finances are under control. I know where we are. I know where we're going, and you provide the solutions we need. Another thing that's not on this page explicitly, but with J.D. Power, we were ranked the #1 bank for trust in the Southeast. What is more important than trust right now? Like when you think about banks, you think about the 2023 crises with regional banking crisis. Trust to me is #1, and we are #1. And so that's really exciting to me. Our team is engaged. Our team is excited. There are a lot of team members here today. I'm really appreciative for that. But our team is excited. Top 5%. When you look at all the banks out there, that's fantastic. I mean, if our team's engaged, serving our clients and growing, that's just the winning recipe for success, and that's how we look at it. But how did we get here? It was a lot of work. Don't worry, I'm not going to go through this slide, but I'll tell you, there are 2 themes on this slide. First is operational excellence. What we realized coming out of the great financial crisis is we needed to streamline what we did, because there were disparate processes. There were people who were doing things different ways, and then we ended up not having a good, and this is an industry story, but we did not have a great grasp on the embedded risks across the organization. And that's what you saw in the banking industry back in 2008. We stepped back and said, how do we fix that? We were committed to operational excellence. So we centralized functions, we enhanced our risk management. When I say risk management, credit comes to mind first. Like everybody wants to talk about credit. Sure, we changed our underwriting processes. If you look at structure of loans, if you look at loan to values, you look at covenants, all of that changed 15 years ago, and everybody experienced that. But also in risk management, there's enterprise risk, there's fraud, looking at how your systems, are built so that you can't be attacked. There's interest rate risk, looking at how do you manage your income statement so you don't, like these wild swings in interest rates don't impact profitability. How do you manage against that? There's balance sheet risk, like you look at capital and liquidity. Like those are absolutely critical. So we step back and reflect on all those. And at $60 billion, you don't have to do everything that the regulators require for the large banks. We don't do the same CCAR stress test that the big banks do, but we do the same thing internally with less documentation. So what we did is we said, what are the best practices? What have we learned from the great financial crisis? How do we bring that in-house? But let's do it without the paperwork. And that's what we do to make sure we're safe and sound. And I think that's why we performed so well last year. And so that's a big success story, and I'll get into that in a minute. The second thing, so operational excellence. The second thing is client delivery. How do we go to market the best way possible? With the best people, with the best products, the best solutions. And there's a lot to that. I mean, people, you know what that is. That's hiring the right team, that's motivating them, that's aligning incentives. But then there's also the product side of it. And how do we ensure that we have the right products to serve our clients? And that has been an exciting journey really over the last 5 years. And that goes as far as saying, let's look at treasury and payment solutions. Do we have the right solutions so that our commercial clients can go and manage their own treasury in a way that helps them bring it all in to one place? And for those who aren't familiar with that, think about things like accounts payable, accounts receivable, cash management, fraud protection, payroll. Like this is bringing all that in-house so they know they can come to Synovus if they need a loan or a place to put deposits. But how nice would it be if they could bring all that in and have one system that they log in, make sure their people get paid, make sure that their receivables are coming in, their payables are going out. That's what we built over the last 5 years. And now it's all integrated and it's growing. And that's what we're talking about when we say we want to deliver the right products and solution. The rest is technology. We have done a lot of work with analytics in the background so we understand our clients better. Looking at cash flows, looking at inflows, outflows, helping them to know, like, hey, we have a solution. We can provide another line of credit. We see, these flows changing. How can we help them manage their money better? And so we spend a lot of time on that. But that's, when you look at our history, that's really what it is over the last decade. All right, so now leaving Synovus behind largely, I'll talk about Synovus off and on a little bit, but I wanted to hit on three things. One, this narrative in 2023 about regional banking crisis. It was probably one of the more frustrating times in my personal career as a banker. I've been a banker since the beginning. I was recruited from NC State, on campus recruiting, and I've been with it ever since. So y'all can pity me for that. But I'm just kidding. I love what I do, and I love the industry. But last year was tough, and the reason it was tough is because CNBC and the Wall Street Journal and all the major media was out there saying, like, regional bank crisis. Regional banks, what's their right to exist? Are they all going to fail? And they would go in and they would start stack ranking banks by, they would look at uninsured deposits, they would look at commercial real estate, they would just find whatever metric they wanted to find, and then they would stack rank and they would come to conclusions that just didn't make sense. And so we constantly had to fight these narratives. And if you look, if you did a search, our CEO, Chairman Kevin Blair, if you did a search for his name, you see a lot of CNBC interviews. But if you look at the dates of those, you really won't see any before March of 2023. We're not out there trying to put our name in the press, not trying to get out there on major media, but we felt that we had to help dispel this narrative of regional banking crisis over the past 18 months, and I think it was pretty effective. Second thing, commercial real estate. Everybody likes to talk about it and what's going on there. It has been a good story, and I just want to make sure that that story is told for where we are right now in the cycle. And then I want to talk about what have bank management teams done to prepare the balance sheet to make sure that we're ready for the next thing, ready for client growth going forward. Because our outlook is positive. We think that the outlook from here is going to be good. Clearly, we're at an inflection point. The Fed cut yesterday, and if you look at unemployment, it's ticking up slowly, still at a very low level. Job growth is slowing, but still growing 6 figures a month. So how do we think about all that? And so we'll talk a little bit about that. Then we'll have Q&A. So I hope everybody has questions. Again, the predicted demise of regional banks hasn't materialized. That was the narrative, and it to me, it permeated. I'm a podcast guy. I love listening to podcasts when I'm in the car, and even my non-financial podcasts were talking about regional banks. What's their right to exist? Should we be like Canada and have 5 banks? The answer is no. And the interesting thing is they're in a bubble in New York City, San Francisco, Los Angeles, Chicago. They don't know how business works, and I can look around here and see some Synovus clients, and they don't realize that it's not JP Morgans of the world that are out there delivering, helping Georgia grow. It's Synovuses of the world. And we're out there providing customized solutions to our clients so that we can help them win. And that's critical, and that's what was missing from the media narrative. Silicon Valley was the start of the issues in 2023, and with their failure, and then soon after you had a couple others. And that's what I'll talk about here. So, Silicon Valley. So what happened? Because there's a lot of pieces of this narrative that I think are misunderstood. Basically, if you think about venture capital, venture fund, startups, there was a lot of stress in that industry, with startups in 2022, 2023. And what you would see is a lot of these companies operate with negative cash flows already, but it was really hard for them with cost escalating, and they were not getting the revenue required. And that put pressure on their balance sheets. And it was also difficult for them to raise equity to fund that. Well, what happened is that drew down deposits at Silicon Valley Bank, and that kind of started the issue. If you look at their stock price, you can see it starting in the fall of 2022. You see that decline because Silicon Valley had to respond to that. So they have these deposits running down that are low cost, 0%, close to 0%. What they do? They have plenty of liquidity. They had a gargantuan securities portfolio that I'll circle back to, but they drew down liquidity on that. But what happens is when you do that, it goes from 0% to market rates, which is like 5%. So all of a sudden their funding costs just started skyrocketing up to market rates, but they had an issue. That in itself is not a problem. Like you can have rapidly escalating deposit costs or funding costs in a rising rate environment, so long as your assets are paired with that. So long as you have floating rate assets where the yield goes up with them. But they didn't. They had 80% of their assets in a securities portfolio that was residential mortgages that were yielding less than 2%. So all of a sudden, their funding that they felt very good about, running at very low percent funding, 0% funding, less than 1% funding, all of a sudden they had to flip it to market rates, but they had this anchor on the other side of the balance sheet. And the problem is that anchor, those are like 5 and 6 year assets. Like those rates won't change. And so they had an earnings issue, a core earnings issue that was not going to be fixed with higher rates. So you could see it in their stock price ticking down, and then all of a sudden, the market kind of became more and more aware. Hold on, there's an issue here at Silicon Valley Bank, and they got inverted. And once Peter Thiel sent a tweet. I don't even know what you call it now that it's X, but sent a tweet saying, I don't know why someone would have their deposits at Silicon Valley Bank. Well, everybody left. And I think it was on a Thursday, I think they had 40 billion attempted withdrawals, and on Friday another 40 billion, gargantuan numbers. And the bank failed. But you can manage, these things can be managed, and it's so interesting to me because I put the great financial crisis, I lay that issue at the feet of chief credit officers. I lay 2023 at the feet of the chief financial officers because it is not managing the balance sheet appropriately for the risks that are in there. And they just totally missed the change in their funding costs because they did not have it paired on the asset side. So that's what happened Silicon Valley Bank, and we can talk about uninsured deposits. I'll come back to that in just a second. Signature Bank, same story. It was crypto, right? Same story, but it was crypto. Again, crypto was, they were seeing outflows in crypto. Regulation was heating up, and it was not the best environment at the time, and that caused the same story there. First Republic was a little bit different. So, First Republic Bank was a fantastic wealth management bank. When we go in and we do research around wealth management, like who's really good at it, First Republic was really good at it. If you talk to their clients, they would say, I love my bank. And I thought that was fascinating. We did, because we were always looking at, competitors, best in class. You always want to learn, continuous learning. They were really good at it. And it wasn't because they gave mortgages at lower rates, it's because they had a single point of contact that went in, stayed with the client, served their needs, and just made it easy. But they messed up on the balance sheet. Again, chief financial officer. But their issue is different. So they have really high net worth clients, and those clients were very sophisticated. When rates go up, they say, we want to be paid for it. And so they just flipped out of non-interest-bearing deposits, flipped into higher cost, either money market or CDs, and they had the same issue. Funding cost just shoots up, and then you look to the other side of the balance sheet, on the asset side, they have 80% of their assets in either residential mortgages or securities. Again, low yields, get upside down, company's not viable, and then it ends in the deposit outflow, like it ends in the deposit run. Like that's kind of, liquidity is the killer, I think, in all of these. That's what will get you in the end. So people ask about uninsured deposits. Yes, I think deposit insurance should go up. Like $250,000 is a ridiculous number for a commercial client. I think it should be much higher. But I don't believe that would have changed the outcome of these three banks. I think it would change the timing. I don't think it would have changed the outcome of what happened because they were so far upside down. So uninsured deposits is an interesting stat, but it doesn't matter until it does, until the end. And if you were to ask kind of how would I think about it as a client, I think it's really unfortunate that clients have to think about their banks and think about the viability and where banks are. If I was to think about it, I would be looking at really, you can see the early indicators in relative stock price performance. I mean, and it's big swings. Like Silicon Valley, as I mentioned, I think was down about 60% versus the index. And these are big 6-month-long swings. And so I think that's the leading indicator. But it's just stay in conversation with your banks. We have, as I mentioned, we've been building out solutions. We have ways to protect deposits now that are FDIC guaranteed on balance sheet, FDIC guaranteed off balance sheet, treasury solution. Like there's so many different ways that to make it possible. But so the banking industry has adapted to this risk. But I do think that deposit insurance is important. I don't think it'll be addressed because it requires Congress, which I'm not sure what happens there, but I don't think it'll be addressed, but I think it should be. What happened to the rest of the banks? We grew deposits. So in the midst of all this noise, we grew deposits. Like this is the narrative that I don't think is being told. Is this? I was trying to what would show how we performed during the crisis. I think this is the best answer. I mean, people are saying move your deposits to J.P. Morgan. Why would you have deposits anywhere other than J.P. Morgan? Well, our clients knew us. And we had a lot of conversations, and I can look at bankers here in this room that spend a lot of time on the phone explaining safety and soundness, but our clients trust us. Number one in trust, again, that's why it matters. And so we grew deposits. Now, CRE. CRE was another story. People love to talk about office. They love to say, New York City office properties, selling for free, or San Francisco, or St. Louis property that 3 years ago sold for hundreds of millions, sold for $3.5 million. There are all these stories, and it gets in the press, and then people they're lazy, and they love to look at, okay, what banks have higher exposure to CRE? Guess who? It's the regional banks. We have a lot of exposure to CRE, and so they just extrapolate these crazy stories to regional banks, and that's what we have to react to. But I'll tell you, I'll tell you the answer in advance, like it's a good story. I mean, charge-offs have been extremely low in real estate. I mean, for sure, office is there's a secular issue in office. And we can talk about it, but it's a complex one. Because there may be a different answer for downtown Atlanta than for midtown Atlanta, than for up by the Battery where we are, and then for it's very specific. And so that's something that the banks are working through, but we're not seeing the losses. Regional banks are stronger. If you look at the industry, capital and liquidity is really just unbelievable, and credit's been contained. So first, charge-offs. If you look at charge-offs to total loans, you just see a steady trend. Like if you look at since 2000, ignoring the great financial crisis, the average has been 16 basis points, and that's right where we are right now. And that's right where we are right now, heading into an easing cycle. People concerned about the economy, commercial real estate, people like to say it's collapsing, but it's not. And we're still at the average. 16 basis points is very fine. I mean, that's a great place to be. Non-performing loans, which is a forward-looking indicator, so these are loans that are having issues, they're not performing, but they are below the long-term average. So again, these are regional banking numbers. Regional banks are in a good spot at what should be, if you just kind of listen to the rhetoric, a stressful time. And then this chart is CRE. So we created this slide, and I looked at it, I was like, whoa, hold on, this looks like a lower left, upper right chart. I don't know if that's the story we want to tell on CRE, because it looks like it's exploding out of here. But look at the numbers on the left. These are zeros. If you look at the average charge-offs the last 10 years, 5 basis points, 0.05%. These are tiny numbers. Now look, we'll see. We're not through this cycle, and there are a lot of CRE experts in the room, but so far this has been a good story for the regional banks. Now, let's talk about balance sheets. Capital and liquidity. Capital ratios continue to grow. I mean, look at this. Common Equity Tier 1 has grown significantly since early 2023, but I would say it's been growing for a long time. I mean, for us, our capital ratios are the highest they've been in a decade. We have been building capital, protecting the balance sheet, and what we're doing, why are we doing that? It's because we believe that growth is coming, and we want to be there for the growth. We believe our clients will demand it, and we want to be there for that growth. Liquidity, I'm using loan to deposit as a proxy here, 86%, still very strong. And just to put it in context for Synovus, so again, we are a $60 billion bank. We have approximately $26 or $27 billion of contingent liquidity we could get. So if we needed it, we could get $26 billion on top of what our balance sheet today, it's just an astronomical number. So banks are in a good spot to be positioned for success as we go through this next phase of the cycle. And speaking of that, when we think about the next phase of the cycle, our outlook really is positive. Again, we're at a pivot point. Fed eased yesterday 50 basis points. They've said that they will ease another 50 this year. That means 25 in November, 25 in December. They said 100 basis points next year. We believe that means 25 at each meeting, kind of early in the year, and then kind of a pause. What I would say is, look at what the Fed says, probably more than what the market says. The market has been all over the place on interest rate expectations. The Fed has been fairly steady, and so we'll see what happens, but as we look at it right now, we think that that's appropriate. That would get the Fed funds rate to about 3.5%, and then assess from there. See what happens from there. But what happens to earnings when the Fed moves? Well, the top chart, you don't have to get lost in the numbers, but the straight line is the net interest margin. Think of this as the spread between asset yields and funding costs. All right? You can see it's relatively stable. The Fed's all over the place over the last 25 years, but the margin is stable. And that's what I wanted to get to is say, look, we manage our balance sheet to go through cycles and to manage to get through these cycles and maintain property. We don't want people to invest in Synovus because of interest rates. We want people to invest in us because of the state of Georgia, the state of Florida, and growth, and how we're going to go to market. Like that's our thesis. That's what attracts people to Synovus, not how are we positioned versus interest rates. But ROA, which includes credit, has been a little more volatile, and you can see in the great financial crisis how that moved. But I would argue that even that, I would go back to the charge-offs we've seen recently, and everything is much more benign with the lessons learned from 15 years ago. So, how do we look at everything going forward? We feel good about where we stand right now. We are in an easing cycle. As I mentioned, we think we'll get about 200 basis points of easing. That should be stimulative for growth. I get concerned about inflation. I really hope we have, gotten that back to where we want it, and that it doesn't re-accelerate. I think that would be a real problem for the country if we saw an acceleration in inflation. But right now we're in an easing cycle. That does relieve a little bit of pressure on our clients, on our commercial clients, as their funding cost goes down. But interestingly, as we've looked through this cycle, we can't find a single credit that is charged off where we would say, that's because interest rates went up. So we don't believe that on the credit side, 100 basis points, 200 basis points, we don't think that that's like, that flips somebody binary from success to failure. What we've seen is that any issues that our clients have been more operating issues, not just interest rate environment. So but we do think it'll be stimulative to growth. It'll provide a little tailwind. It'll be really interesting to see what happens with residential housing as mortgage rates come down a little bit. And so we're keeping a close eye on that, but we're excited that the easing cycle has already started. The election itself, boy, I mean, it's hard to turn on the TV, but ready to get past that, especially here in Georgia, where it's we're sitting here right at the edge of it all, a state that really matters. And so we look forward to clarity, a little more clarity on what the outlook will be, what the fiscal policy will be as we get past November. Hopefully we have answers. There are scenarios where it's still uncertain. Not as far as the election, goodness, I hope not. I'm just talking about as far as knowing the full policies of whoever wins. But we're looking forward to that. And then I'll talk in a minute about M&A activity and our expectations there. But first, let's talk about the Southeast. We're in 5 states. Every individual state that we're in is projected to grow faster than the nation as a whole. And we know we're in the best nation in the world, but now within that, we're in the best spot. Like, this is the place to be. If you were to start a bank and you wanted to grow a bank, you want this map. In 2018, we bought Florida Community Bank to add, really a big stake in Florida. And I think that's the perfect combination. Florida and Georgia, as far as population growth, economic growth, is a great, great combination. If you think about it, GDP, what is GDP? GDP is population growth times productivity. Well, we believe that population growth is going to be really good here in the Southeast, and so led by Georgia and Florida. Productivity, speaking of productivity, artificial intelligence, I'm pretty excited about what's going on in artificial intelligence, but I will say for us it's a challenge. We are a heavily regulated industry. We care a ton about our clients and how we treat our clients, and so we have to be really careful about how we leverage what's possible with artificial intelligence. These are a few of the easy ones. Like, there's nothing that's really sexy in here that's a game changer, but this has helped our teams. Think about our voice of the team, top 5%. It's things like these first two that really help them. Branch procedure search. You think about it, if you're a teller or a branch manager and you get a random request that you haven't had in 3 months or 6 months, this is an AI, large language model. You go in, type in your question, you get the answer. I mean, this is 1.0 of large language model technology, and it helps. That makes their lives easier. There's no risk. It points them to the right place. Contracts GPT, we put in our contracts. We have it set up. We know what we want, how we like them. We drop in what the vendor sends in, and it tells us these are the things that are different. These are the recommendations. This is how you should, what you should go back with when you try to adjust the contract. Fraud detection. This is a big deal for us. Fraud is unbelievable. I mean, it's fascinating what's going on in fraud. It drives us crazy. We spend a lot of time trying to protect our clients. Like this is us playing defense for you. But this tool right here, it's basically just how to filter and prioritize issues of fraud. Just public service announcement. There are a lot of young folks here in the room, so you probably maybe have never used a paper check, but don't. Just try not to. There's so much out there. I mean, it's so crazy. One of the things we've seen recently is they will steal a paper check from the mail. They will go online and get a fake ID, which I'm sure no one here has ever heard of that you can do that. And then get the fake ID in the name of the person on the check, walk into the branch and cash the check with a state ID with the name that the check was written out to. So they're not even messing with the check. They've just stolen it and they've used a fake ID. We even had one time where somebody who was very important to the bank wrote a check to somebody who was stolen out of the mail. Someone did a fake ID. They went to the branch. Branch teller was like, something doesn't feel good here. They called the client. The client said, yes, I wrote a check to so-and-so. And they said, okay. And they cashed it. And that was not the person. Because they didn't ask, like, well, what does the person look like? Or what, but anyway, like, the fraud is super sophisticated. And that's digital fraud obviously is huge, but the paper check things is unbelievable. AI Copilot, you all probably have this on your computer. It is fantastic. And so I think it's been really helpful. I mean, you can go in and type in, well, you all know this, but summarize the most important unread emails of the last 2 days. And it'll do that. I mean, of course, you got to check and make sure nothing's missing. But create a PowerPoint, and it'll create the PowerPoint, and you'll want to go through and adjust it. But it just saves a lot of time because it kicks off things. It helps make life easier, and that's what this is all about. It's like being more efficient. For us, though, being regulated, you gotta be really careful. If we had co-pilots sitting in on meetings and recording them. What if you're in an asset and liability committee meeting and you're debating putting on hedges or putting on a transaction, and you make a statement of, hey, that could be really bad if that happened, or words could be taken the wrong way, and so it's just you got to be careful in how you deploy these tools that really can help make life easier. Last, on M&A, we've seen some deals. Now look, these are all smaller deals. You think about it, the big question is going over 100 billion, what does that look like? But I tend to believe that smaller deals will be well received. The stock market has agreed. Like if you look at the price reaction on these deals, it has not been negative like some deals have been in the past. And so I think the market is generally receptive to these. And I think the reason the market is receptive is because they see the cost pressures in this environment. They see the pressure in the environment, and they say, you know what? If a bank goes out and buys a smaller bank, takes the cost out of the target, and then can continue to grow, we think that makes sense for the shareholder. Now, what they're really concerned about, I think, would be some of the scenarios that they've seen elsewhere with mergers or equals that haven't gone as well. And you got to be careful. You got to make sure there's the cultural fit, strategic fit. You can't just go out and do a deal for the deal's sake. This is a survey at a Barclays conference a week and a half ago. I was shocked by these numbers. 90% of investors said likely or very likely that they would be supportive of M&A, which I'm not sure it's ever been this high, but that's really a cost story. So, wrapping it up, look, we're here for Georgia. We're here to help Georgia grow. Terry College is fantastic for us because Terry, graduates here that help us grow and help us win and go to market. And so I'm excited to be here. I'm excited to be here in the state of Georgia, watching this all happen. I think we have a great opportunity here in front of us. And now let's open it up for questions. Yeah.
So I'm coming at this from the ABS side, but similar to the AI thing with regulation, another big thing we're seeing recently is consumer data, and specifically consumer data privacy. Do you see that disrupting the ABS market, since consumers want to own their data and determine who you can send that to, whereas investors require detailed, redacted potentially, but actual detailed reports on the performance of the bonds?
It is extremely important for us to control the data that we have and to use it the right way. And so it'd be a really rare, I can't think of a time where we would send our data externally. On the consumer side, we don't have, we retain, the only mortgages that we don't retain are ones that we send to Fannie Mae and Freddie Mac. So we're not really in the ABS world. We don't originate auto loans, things like that. But we keep all of our data in for us. And I think that does, to your point, it could open a Pandora's box of data issues. And when you think about things that can stall a bank, it's compliance on things like that would really impair your ability to grow. And so I think that's an area where you really just can't mess up. And so the consideration of sending client data external, I just can't think of the scenario where we would find that beneficial to us or our clients.
Okay.
Yeah.
Thank you.
Yeah.
Hey, good morning, Jay. Thank you for coming this morning. Just a quick question following up on what Al just asked. Do you have data scientists internal that are building your large language models?
Yeah, so Timothy asked, do we have data models internally that are helping us build our large language models? Absolutely. And so for us, we have so much data. I mean, there are very few industries that have as much data as we do. When you think about transaction level data, everything that we're doing on the consumer side, commercial side. And so we have a lot of people out there helping us construct ways to use this data. And you talk about large language models, but we've also, you and I were discussing earlier today, sometimes it's even more simple than that. It's leveraging business intelligence tools to aggregate and combine the data in a way that's not necessarily native to the system. And so we have teams that are working along all of those lines. I mean, because we need to know, I see Rob here, we need to know, Rob's sitting here with a great set of clients, providing great wealth advice. How do we ensure that we're serving their needs on their core banking? How do we tie people together? How do we tie commercial clients together to make sure that we're bringing all the solutions together to them in ways that aren't native in the core systems? So we have a lot of data structuring, business intelligence, and then the newest would be on top of that, leveraging large language models to help us think about how to use that data in the best way. Yep. Yes.
Jamie, thanks so much for your time. 2 questions. Her favorite podcast, since you said you're a big podcast guy.
Yeah.
Right now.
All right. So my favorite podcast, and I feel like this is generic because it's become the top one, is the All In podcast. I think it's fantastic. So for those who aren't familiar with this podcast, it's these 4 guys who are in venture, and one of them, I just wanted to wring his neck during 2023 because he was the one saying regional banks would collapse. But I find that they just debate things, and they actually come to it with let's explore these issues together. And I enjoy their candor and how they think through problems, because I think it helps me think through what's going on in the world and how to think about it. So that's one that I really like. And then another one, and it's funny because the people who recommended these to me are in the room, is I like to start my day with, there's a podcast called the Vital Dawn podcast, which is a market podcast, and it's like 4 minutes long, and it basically is like what's going on overnight. I think that's a good way to start. Nice for the car ride in if you care about the markets. Oh, you have a second
Yeah,
question?
and that's a good segue. The first is a good segue to my second real question is, you talked a lot about sort of the overload of information and the lack of, I guess, quality information out there. What is the strategy for disseminating that with your clients? How do you advise them against, true risk, but also like what is the real condition? Because you can see a headline, I think everybody in this room can probably see that, and it induces fear or concern. What is the strategy for coming back to your clients and saying, here's really where we stand, here's where your risk is, but you're safe here? How do you strategize that way?
You have to be nimble because typically they're unexpected. 2020. The question was, how do you communicate effectively with clients about risks that are out there, and when things change, how do you get them comfortable with the bank and what's going on? It always evolves, and I think a good example, and we were just talking about this, was last year. The narratives in the press evolved rapidly, and the one I didn't mention that was out there a lot was unrealized losses in the securities portfolio. Like people were tying, you have a securities portfolio, it's underwater, that's a problem. And that's a very logical, train of thought. But we had to help them think through, like, why do you care? And the reason we had to help with that, and the reason why you shouldn't have cared, except for in some instances, is because we have, if you look at normal banks, diversified deposits, clients who do all sorts of different things, there's a set of non-interest-bearing deposits that will be on your balance sheet forever. And it'll bounce around. We were at the peak 35%. Right now we're about 23%. It'll bounce around in the low 20s for a while. Well, I pair that with a securities portfolio that right now is about 18% of assets. And so, am I happy that my book yield on that securities portfolio is in the low 3s? No, I don't. We can invest in days up to 4%. But it's paired against 0%. So for me, it's not a problem. For Silicon Valley, it was a problem because they didn't have that 0% deposit. All theirs went up to 5 because they were not a normal bank like us. They were so monoline. And so the stories evolve, and so we have to be ready to tell the story, but it takes a team, and Jennifer's here who runs investor relations, and we have Brendan here who runs corporate communication. Like, we spend a lot of time stepping back and thinking about the receiver of the information and how do we tell that story, because these are things that we think about all the time, but what we find is we're too technical in our thoughts. And so we gotta think about how do you message that in a way that will be well received, and people won't just say, what, I'm going to JP Morgan. Yeah, thank you. Yeah.
Can you talk a little bit about the bank's view of the macroeconomic impacts of the basis cut? It seems like there's signals flashing, bad economy, but there's also a good thing. Like, what is Synovus' view of next year?
Yeah, I think it's going to be really interesting. Inflation has been really tough for the consumer, and it matters. And so when you look at where the consumer is, I do believe there's stress there. I think that'll flow through to some of our commercial clients. And so I think that, inflation trending to 0 is to 2 is extremely important. Like, that needs to be managed, because if we start to see that tick back up, then I think that's a real concern. To me, it's binary. You have to control inflation. But assuming that we have checked that box, the easing cycle will be positive to growth. I think it'll unstick a little bit of things in residential housing, hopefully. If inflation stops, hopefully that'll unstick things a little bit in residential housing. This will be a relief on the commercial real estate side. I think in general, we're going to see a tailwind to growth. Now, I think that the next 12 months, it's going to be, we're not going to see a lot of growth, I don't think. But it'll be interesting to see what happens. I mean, we could easily have fiscal policy that's restrictive on growth, and we could easily see fiscal policy that's pro-growth. And so I think that the next 6 months we'll learn a lot. And for me, the 2 things I'm watching are inflation and then the outlook for fiscal policy. Yeah, Casey.
Imagine I'm a UGA student looking to get into the banking world right now. We've heard some sensationalized news lately about these 100-hour work weeks for some firms like JP Morgan.
Yeah.
Imagine I'm a student and I'm like, I don't really want to work 100 hours a week.
Yeah.
Is the regional bank a better place to work? How do we?
90 is
how do you respond to somebody who's afraid? Like, I want to have a life. I want to have a family.
Well, the first thing I would say is think about that voice of the team. I don't think if you're pushing a team like that, you're top 5%. I think the team is telling you this is a good place to work. And obviously I'm speaking for Synovus, but I imagine, well, they're not, other people aren't top 5%, but hopefully they're not, they're okay. But I think that's number one. For us, we, like what we value is first, you gotta have the right skill set, right? You gotta have the foundation, which you're at UGA, you're gonna have the foundation. The core skills you need to be successful. But then what we want to see is we just want to see a passion and curiosity. We want people who come in, they're passionate about banking, and they're curious about how they can help their clients and grow the bank. And then you can drop in, banking, there's so many different jobs. Timothy and I were talking earlier about, business intelligence jobs, AI jobs, but then there's marketing, communications, core banking. You think about being there in front of the client. There's credit. There's so many different things you can do. So I would just say, one, for work life and how you think about that, depending on the job, there are busy times. And there are times where things can get hectic. If you're working on a deal for a client, for us, it's earnings. End of the quarter is always crazy. But there, I think it's a good industry, and when you look at top 5% voice of the team's happy, team's engaged. They wouldn't be if it was if we were just grinding it out. And so the other thing I would say is when I talk about the passion, when I think about successful careers, I group them into two groups. There's builders and creators, and those are people who are out there and they, you think about it in technology, like building and creating. You are out there driving new technology. You are creating code, you're building something. You may be a research doctor and you're helping solve cancer. You may be a teacher and you're teaching people. There are all sorts of things in that sector. But then there's also a group that are facilitating the success of the country. How do we make it happen? And I think that the banks are at the heart of that because we are the ones who are out there with our client helping them win. And if that's in your heart, if that's what you want to do, which is why I'm still in the industry, then that's a big deal. And that's the fuel, even for someone like me that doesn't, Charlie never invites me out to see clients, but it's they keep me in the basement. But it's that's what we're here to do. And so it's if you find that passion, and if that gets you excited about saying, I want to see Georgia win, I want to see the state of Georgia win. For Georgia to win, our commercial clients, consumer clients have to win. Then that's what will drive your success and the fun you'll have in the industry, or at Synovus. Yeah.
Hey Jamie, you really contrasted the regionals like Synovus versus the money centers, but how does Synovus think about the opportunities and threats with fintechs and other entrants into the banking space?
The question was, how do we think about non-bank competitors? So fintechs, it's a really good question. There are people doing really interesting things out there outside of the banking industry. And a lot of that is on the consumer side. And so clearly we're involved over there, but that's the right to win for us is probably more on the commercial side with C&I and real estate. But we either partner or we compete against those people. And so there are many instances where we partner. On the consumer side, a lot of the non-bank competitors are out there in the lending space, and the last couple of years have been really tough for them. They have struggled because of their funding costs is all marginal. And so they're seeing volumes decline, funding issues, profitability headwinds. So they're trying to figure out their future. Sometimes we partner and try to help out with that, either funding some of their loans or leveraging their platforms. But typically, we just kind of keep an eye on those on the consumer side, because we're not as I'm a lot more interested in a residential mortgage, a home equity loan, a consumer unsecured loan for a client that we're trying to solve all their solutions than just for that product itself. Like you tell me we want to go grow a HELOC, that in itself is not exciting. But if you say, this is my client who, does all these other things with us and we're helping them win, then you're like, yeah, we're helping, let's solve all their needs. And so I get less concerned about the competition there. I get a little bit frustrated that there's not as much regulation. I feel like they get to skirt some of the rules that we compete by. But I haven't viewed those as the biggest threat. On the commercial side, it's really interesting because commercial competition for credit has really increased. And I do think, I'm sitting here glossing over CRE, and there's probably people in the room who are like, holy cow, he is blind. There are real problems in CRE, and I tend to agree, but I think you're going to see it in the non-bank areas. I think you're going to see it with the mezzanine lenders. I think you'll see it with CMBS. You'll see it with some of those other large funds. And so it's really interesting to see as we go through these cycles, where the stress is, either on interest income with high funding costs or credit, who's experiencing those ebbs and flows. There are some banks right now who are considering partnering with non-banks as far as originate to distribute on the commercial side, and that's a little bit of a newer phenomenon because we have a pipeline. We have clients who have needs, and so we will continue to originate loans and grow our balance sheet. There are some banks that are saying, I'm full, I don't want to grow, so they're looking for partners. We're not that attracted by that, and the reason is two things. One, I never want to hand a client off to somebody else. I just think we do it better. I want to take care of them. I want to make sure we do that. But two, I want to be in the room if things go wrong. If something goes wrong, if that client has a bad experience, I want Synovus to be the partner who's there with them, rather than name your very large private equity fund, or asset manager. I think that's the right thing for the client. I think we can help get to the best solution versus maybe the most expedient solution. So, we keep fighting these things. I wish the playing field was level, but for us, it's not the biggest deal right now. Thank you. Yeah.
So last question.
Even if you guys you aren't required to comply with CCAR stress type initiatives, do you find it beneficial for regional banks as they're growing like Synovus to begin kind of planning for that, or the granularity to shift down to a little bit more smaller banks?
Yeah, so the question is we don't have to do this stress testing like CCAR. Do you find it beneficial to do it? And we absolutely do, because we want to build the most resilient franchise that we can. We want our bank to be safe in all scenarios so that we can get through a 2023 or whatever the next one is. So we think it's very valuable, and it's actually how we run the bank. We do a lot of liquidity stress tests and capital stress tests. Synovus, I do believe, is unique, because if you look at what Kevin has done since he became CEO, the finance organization, the risk organization, the audit organization, they're all people who came from banks over $100 billion. And so there's a lot of that native experience and kind of how to think about all that. And I think that's a real positive, because we're always running scenarios in our mind to help make sure that the client's safe, the shareholder's safe, and I think that's the right thing to do. But there's an interesting counter story to this, which is New York Community Bank, and it's probably a slippery slope, but they rapidly grew over $100 billion, and they did a couple deals, and they almost failed. It was very close, and some of the blame on the issues there have been, oh, well, they crossed over 100 billion, and then the OCC was looking at them, and when they looked at them, they said, hey, you know, you guys need to change A, B, and C. A lot of that had to do with life and loan loss estimates. Well, that was a bank that didn't have, if you looked at their team, these were bankers that, you know, came up from being 40 billion, 50 billion, never done any of this, and then just rapidly just catapulted over that threshold. And so they weren't thinking about it like we are right now. And so I do think it's important to look at, when you think about how management teams think about their bank and how they look at it, because that, I think it's extremely important to do this and to make sure that you're safe. And, you know, I mean, look, we're nowhere close to 100 billion, but if we were, I don't think that leap over 100 is that big of a deal for us, because we're already kind of doing it. Do I need someone to write, you know, a 500-page document? Yes, I do actually. But do I know what that 500-page document would say? Yeah, we actually know what it would say. So, you know, for us, I think we're very well positioned. But I think if you were just to look organically at banks that have just kind of grown up and then catapulted above, it can be a concern. Well, look, thank you so much for having me today, and I appreciate all the questions.
Jamie, we've got a nice red and black.
How are you? I love it. Matches. Yeah. Thank you.
Really appreciate you being with us today, and also, again, thanks Synovus for the great partnership that we have. For all of you, if we have not given you a validation for your parking, please see us as you go through there, and I hope that everyone has a great rest of this month. Look forward to seeing you back in October. We'll have Scott Styling, and have a great weekend. Of course, go Dogs.
Good dog.